all of us who've seen a particular contract of crude oil contract and go into negative have seen history of sorts being made. Well, let's get in somebody who tracks this very, very closely to talk about how has she viewed this move and what are the implications of this going ahead. Mriganka Jaipuriyar, Head of News Asia, S&P Global Platts, joins us right now from Singapore. Mriganka, good having you. Thanks for joining in. It was an anomaly due to near-term issues, but you can't wish away or not observe the larger price damage trend that we're seeing in crude. How do you view what happened yesterday particularly and the overall trend in the near term?
Yeah, so what happened yesterday, I think it is important for us to note that was limited to the U.S. futures contract and the May futures contract specifically, which was due to expire today. So you had many people in the market holding these long positions, but nowhere to take delivery of the oil. So there was a lot of selling pressure on these contracts. But if you are absolutely right, if you look at the of what is happening in the oil markets today, I think it's only getting a little more bearish than we've seen recently, with storage tanks filling up a lot quicker than we had originally anticipated. Storage tanks, when we started out the year, we had about 1.5 billion barrels, according to Platts Analytics, of spare storage capacity, and we're expecting to hit a tank top situation in May. What that will mean is it will be further downward pressure on prices, which would force producers to curtail production because there will be nowhere for this oil to go. And on the demand side, things are not looking any better because we are not seeing a big recovery in demand. We are not seeing the lockdowns ending. Lockdowns have been extended in India. They've been extended in the UK. We're not seeing those lockdowns ending. So we're not seeing the global economy coming back into business. Platts Analytics has further downgraded its demand outlook for the year. We're now expecting a contraction of close to 7.8 million barrels per day for 2020, and in Q2 we're expecting contraction of about 17 million barrels per day. So that's 17% of demand wiped out of the markets in this quarter.
Mriganka, good morning. Just the fact that obviously the May futures now seem to be a little bit of an aberration because of the fact that, the storage at Cushing is running out at a breakneck speed, and by mid-May there's going to be absolutely no storage. The underlying, leaving this aside, the underlying fact still remains that despite a historic deal, a 10% production cut that was agreed upon, this is nowhere enough to curtail the kind of glut that there is in the system.
Absolutely. I think the 10 million barrel per day, it was widely known even after the decision was made that this is not going to be enough straight away. What it will do, and the production deal is running right until April 2021. So what this will do is we will see oversupply. We will see a drawdown in stocks as demand starts to recover, and OPEC Plus is compliant with these production cuts. We will see a stock drawdown going into the second half of 2020, going into 2021, we will see a drawdown in inventory, and that should provide some support to prices. So I think it was widely expected that this OPEC Plus deal of a 10 million barrel per day production cut will not have an immediate impact on the market. What it will do is support prices further down the curve starts to recover. But I think it all hinges on a recovery in demand. And if that scenario, if this lockdown scenario extends further into Q3, Q4, then the recovery gets delayed, and the price recovery and the price support for oil markets delayed. So at least in the near term, I think producers should brace themselves for further pain going forward into the year.
All right. What does this mean for a country like India? Obviously, we look at Brent, but what does this do for our imports? Because we've seen most of some of our oil marketing companies as well not being able to lift supplies because they're already heavy on inventory.
Absolutely. I think Indian refiners have, in fact, because of the lockdown, they've been forced to cut operating rates at their refineries. If I'm not mistaken, it's down about 50% at the moment, which means stocks are building up. Crude they had bought still sitting in their tanks. Products is sitting in their tanks. India's strategic petroleum reserves is not, the capacity is not very large. We have capacity of about 40 million barrels in India, of which I think 50% is already full. So India does not, it's unfortunate, but India does not have capacity to buy crude at these rock bottom prices when they could have to store for strategic purposes. Yes, once there is a recovery in demand and prices stay low, of course, it will benefit the Indian consumer and the Indian economy because your import bill comes down, your cost of operations comes down when your oil prices are low. But at the moment, I think where India could have benefited was buying for strategic purposes, but unfortunately, they don't have capacity to make the most of the situation.
Trying to understand this now with demand suffering, if you do see storage facilities packed to the brim, now mid-May is when the expectation is that Cushing is going to fill up. Demand, is it picking up at that big a pace for the consumption to reduce the stockpiles to create place for fresh inventory? Because then again, the contango that we're seeing in the months of June and July will start to shrink.
Right now, we are not seeing a demand recovery. There is some buying that is happening. It's a very slow recovery. The rest of the world is not seeing a demand recovery, hence the concern. But what will happen is as we reach tank top situation and prices are pressured further lower, there will be an involuntary production cut from U.S. shale producers, from Canadian producers, Brazilian producers. They will be forced to cut production because there will be nowhere for this oil to go. And right now, the production cut announced by U.S. producers is about 1.3 million barrels per day, and we could easily see that rising at a rapid pace as storage capacity fills up and demand has not recovered.
Okay. Mriganka, we'll leave it at that. Thanks much for taking the time out and speaking to us today on this big.
Thank you.
Pleasure having you. Pleasure having Kishore Narne as well. He's Associate Director, Currency and Commodities at Motilal Oswal Financial Services. Kishore, good having you. Thanks so much for joining in. Just a brief, broad brush before we get to the Indian piece as well. How do you expect, what's the trend that you guys believe crude will show over the course of the next say a few weeks, if it's possible to predict that?
Hey, good morning. I don't think it's that easy to predict crude at this point of time. But still, we are bearish on crude, and we are looking for WTI to sustain somewhere close to around $15 or slightly lesser than that. So yesterday, going to a negative is like a freak trade. So ignoring that, which has a very different outcome. But in general, the second month contract, which is the typical crude price, is somewhere around $15, or somewhere between 10 and 15 is the ideal price for crude.
Kishore, how does this impact Indian traders? Because there's a lot of talk going around about how the markets shut at 5 and then the NYMEX prices are taken. So what happens because of yesterday's negative price? Is there what's the impact?
I don't know. Probably regulators and exchange will take a call on how to settle this. But typically, see, I need to mention a couple of pointers. One is that so when we are comparing the NYMEX price, NYMEX is a deliverable contract. In India, it's a cash settled contract. And on NYMEX, as a buyer, when you say negative pricing, that means you get crude, and over and above that, you get more money to keep that crude. So the seller is actually throwing away crude and paying you to take the crude. But in India, so that actually benefits the buyer. But in India, unfortunately, it's a cash settled contract. So here the buyer is on the losing side. So it's an irony that in the same contract at the same settlement price, in one contract on NYMEX where the buyer is getting the benefit of lower price, And here the buyer is losing because of the negative price. So it's an irony of the situation, and I think regulators and exchanges will take a call on how to settle this.
Okay, what are you advising clients to do currently on crude? I mean, is there a no trade zone right now, or can people take specific trades?
See, of course, the volatility is going to be high. Of course, the client has to understand the risk is too high. So we normally say that people who don't want to take that kind of risk to stay away, but people who are taking the calls should have a strict stop losses and probably keep it intraday rather than carrying forward overnight.
Okay. Kishore, leave it at that. Thank you so much for taking the time out and speaking to us. Well, so even to the experts, not quite clear as to what the impact of yesterday's price fall would be on trades that were taken and kept because the Indian market shut at a different time point compared to some of the others. But a story around this on our website as well, BloombergQuint.com. So do try and read more about that. And viewers, thanks for tuning in to this broadcast.